Laser centered on how aggressive the Federal Reserve will be in tightening policy, some U.S. investors and strategists are starting to worry about what may feel a distant danger on a sharp economic deceleration or the coming recession. In today's video, we'll discuss why Peter Schiff, a famous American stockbroker, financial commentator, and radio personality, thinks the recession is just around the corner. But before that, make sure you press that red subscribe button along with that tiny bell icon to get updated every time we post new videos. Let's get started. Investors have been unnerved in recent days about the possibility for a more hawkish Fed than preliminarily anticipated. Some are concerned an aggressive interest rate hiking cycle combined with a reversal of the U.S. Central Bank's bond buying program could bring too sharp a deceleration. But they still haven't come to grips with the fact that this isn't going to fix the inflation problem. In his podcast, Peter Schiff argues that the recession will actually end up making inflation worse. The stock market finished up last week with further selling as investors begin to price in more Federal Reserve rate hikes. Some analysts now anticipate as multiple as 10 hikes by the end of 2022. Peter said that's alarming the markets. And in fact, if you look at the yield curve is actually flattening because investors are actually starting to price in the recession that is hawkish Fed is going to cause by jacking up interest rates. The yield curve between 2-year and 10-year notes flattened to lower than 75 base points in January, the smallest gap since the 28th of December. U.S. benchmark 10-year yields retrenched this week as stocks tumbled, which was partially seen as a flight to safety but gave a measure of the delicate tightrope the Fed faces as it plans to start draining epidemic impulse liquidity from the markets to fight surging inflation. Peter said the 10-year Treasury yield is factoring in a drop in rates that will follow all of the hikes because they will bring on a recession. But in the big scheme of things, 10 rate hikes are nothing. However, the interest rate will only be at 2. If each hike is 2.5% base points after 10, we don't even have to use the real inflation rate to make the point. We can accept the government's cooked CPI data. Indeed, if the Fed raises rates to 2.5%, you've got 5% real interest rates. The reality is that a 2.5% interest rate in the face of 7.5% inflation is like taking a pea shooter to a bazooka fight. In order to truly constrain inflation, the Federal Reserve needs to push interest rates above the position of inflation. No one is talking about rate hikes up to 7.5%, and indeed, if the Fed manages to hike 10 times, the CPI will probably be even high by the time rates get to 2.5%. But while they are not sufficient to fight inflation, these rate hikes will presumably push the U.S. frugality into a recession. The markets feel to be starting to grasp its reality, but they still think that the recession will do the job for the Fed and push inflation down. That's all for today. Let us know your views in the comment section below, and don't forget to like this video before leaving. Thanks for watching.